All right, well, we'll go ahead and get started. Thank you all so much for joining us today as we break down the One Big Beautiful Bill Act. I am Drew Barnes, the Director of Financial Planning here at Traction Financial Partners, and with me today is Ryan McNamee, our Associate Planner. And while this is a very wide and sweeping legislation, we're really going to be focusing in on the tax components today. And just some house cleaning items on the front end here. There is a chat box on your control panel. If you'd like to type questions into that, we will certainly be getting to those at the end of today's presentation. So if a question comes to mind at any point, go ahead and drop that into your chat box and we'll get to those questions at the end. Okay, so starting with today's agenda, we will just do a brief overview of the bill, its estimated costs and impact. We'll then dive into the individual tax provisions, including the extensions from the Tax Cuts and Jobs Act and some new provisions. And then we'll wrap up with some business provisions and then some other items that we think are worthwhile discussing. So let's go ahead and dive into the overview. And the bill was signed into law on July 4th, so Independence Day this year. And it was done through what's called the reconciliation process. And the reconciliation process is what allows a bill to be passed via the Senate with a simple majority of 51 votes, kind of bypassing the filibuster 60 vote threshold. So with Republicans holding all chambers, the reconciliation process allows them to pass bills without any Democrat votes. So it was signed into law on July 4th this year. And the bulk of what it did from a tax perspective is it permanently extended the majority of the Tax Cuts and Job Act provisions with some slight modifications. Now, we have permanently there in quotes because it's permanent law until it's not. So, of course, laws can be changed, but as of now, it is law, so it will take another act of Congress and president to sign into law to remove any of these provisions. And then last, it definitely has some very intriguing new provisions that we'll be sure to go through, such as an extra senior deductions for tips, tip income, and overtime income. Okay, so the Tax Foundation is a nonpartisan think tank that provides its analysis on tax policy. And so once the bill was passed, they kind of ran all the numbers and did some modeling, and they came up with a lot of estimates that are, of course, just estimates, but nonetheless, they are going to give us some direction of what we can maybe expect for this bill. So through the incentives to work, save, and invest, they are estimating that it expands long-run GDP by 1.2%. Now, a lot of the provisions that we'll look at here are just temporary over the next few years. So it actually is assuming GDP goes up higher, close to around increase by an extra 1.5% for a few years before falling back to a long run average of 1.2% in GDP as those provisions expire. Now, that does not come without a cost. It does estimate that it will add 3.8 trillion through deficits to our debt over the next 10 years, increasing what they estimated would have been a 117% debt to GDP ratio to 126% in 2034. Now, you can take that 117% with a grain of salt because we're already at 120% today. So I'm not positive that that would have come to fruition over 10 years, but nonetheless, it is expected to increase debt by an extra 3.8 trillion over 10 years per the Tax Foundation. Now, it does provide on average in 2026 an estimate of a little over $3,700 in a tax cut per taxpayer. and prevents tax increases on approximately 62% of taxpayers. So it definitely, it is going to result in tax savings for the vast majority of Americans. And, $3,700, when you see estimates of, approximately 60% of Americans living paycheck to paycheck, that's over $300 a month. So that actually makes a bigger impact than it may seem. And it estimates that it will create approximately 938,000 jobs in the long run. Now, on the right side of our screen, you can see that we have average tax cuts by state. So this is pretty interesting. You can see Wyoming, Washington near the top there, and they are states that do not have state tax income. So that makes sense there because obviously, if you don't have a state tax to offset some of the benefits of the bill, that'll give you a bigger bang for your buck. Same with Florida there. And then you will see California there at the bottom. So it also is good for high tax states and high property tax states. And we'll get into why that is. And then you see Colorado on there as well. And it's because Colorado has a high conformity to federal tax laws. So there's a lot of states that do not conform fully with federal tax law. And Colorado, for example, is one. So a lot of the benefits are not offset. And with that, I'm going to kick it over to Ryan, who's going to talk about the extensions and modifications.
Yeah, so thanks, Drew. As Drew said, the bill largely extends a lot of the provisions that were put in place by the Tax Cuts and Jobs Act. And here are a few to kick things off. So individual tax rates, they were reduced under the TCJA, and the OBBA extends those permanently. So you can see in the chart on the right there that if the bill wasn't passed, rates would have reverted back to 10, 15, 25, all the way up to 39.6%. And with the bill passage, they stay at 10, 12, 22, and all the way up to 37%. In addition to the lower rates that are extended, the bill adds an additional inflation adjustment for some of the lower brackets. So the chart in the bottom right there kind of shows the first bracket gets an additional couple $100 added to the top threshold. The second bracket gets somewhere between $1,000 to a little under $2,000 for the upper threshold. So we have the tax system is a graduated system. So this, applies to everybody. More money is going to be taxed at lower rates. That's basically what that means. The standard deduction under the TCJA, it effectively doubled the standard deduction, and the bill extends that higher standard deduction with an additional increase to that as well. So you can see the amounts there for depending on your filing status. So a single filer had a $15,000 standard deduction this year, and that's going to be increased to $15,750. And head of household goes up to $23,625. Married filing jointly goes up to $31,500. And the state and local income tax cap. So this is a modification. The TCJA or the bill increases the amount of state and local income taxes that you can deduct as an itemized deduction from $10,000 to $40,000. And if you're married filing a separate return, that's you're capped at $20,000. This one is not permanent. It goes from 2025 to 2029, and in 2030 it reverts back to the $10,000. So this is state and local income taxes that you pay, as well as property taxes on your house, for instance. It also adds an inflation adjustment to the deduction to that $40,000 each year through the time period that it's available. And the way this one works is that the deduction is reduced by 30% of the amount that your adjusted gross income exceeds $500,000. And just to define magi for this specific, well, for most of the provisions in this bill is for the majority of people, it's just going to be your adjusted gross income. So money that you earn from wages or pensions, for example, reduced by some adjustments to income, get you your AGI. So if we say MAGI or modified adjusted gross income, that for the majority of people, it's just your adjusted gross income for these provisions. So the deduction phases down by 30% of the amount that exceeds that $500,000 cap or $500,000 threshold. And it goes all the way down to a minimum of $10,000 once adjusted gross income exceeds 600,000. And if you're married filing separate return, it phases down to $5,000 for Magi in between 250 and 300. There were some in the House version of the bill, there was some changes to this that would affect the PTET election. So for a pass-through entity who is electing to deduct state and local taxes as a business expense to kind of circumvent the cap on state and local on the SALT cap. There's no changes to that. You can still do that. So that's worth adding in there. So, and we're going to go through an example here of the SALT cap. So to just kind of show you how the phase down works. So someone with Magi of $500,000 at the top there has itemized deductions of 40K related to state and local income taxes and 20K of mortgage interest. Their SALT cap or their SALT deduction is not reduced, so they receive the full $60,000 in deduction. But they need to keep in mind that any dollar that they earn above that $500,000 limit is effectively going to add $1.30 to their taxable income due to that 30% phase down of the SALT deduction. And that's kind of shown in this next example where a taxpayer has $550,000 of Magi, same amount of itemized deductions. Their SALT deduction is reduced by 15,000, which is 30% of the amount that's over that $500,000 threshold, which is 50,000. So 30% of 50,000 is 15. For a total amount of itemized deductions of $45,000, 25 coming from the SALT and 20 from the mortgage interest. And when you calculate the effective rate on the extra income that this person earned, it comes out to 45.5% on that $50,000, which is effectively $1.30 times the 35% bracket that they're in. So for someone who's kind of on the cusp of breaching this $500,000 threshold, there's some opportunities to either reduce your AGI, reduce your total taxable income, or shift your income to a different year. So some things, some planning considerations for this one would be making sure you're maxing out your 401k or other retirement contributions that you're making if you're self-employed, or reducing your AGI by contributing to an HSA, which the maximum for most people is $8,500 this year, and income timing. So if you have the ability to, if you're self-employed and you have the ability to push income into maybe the next year, or kind of manipulate that where you're not going over the $500,000 threshold, that might be a good idea, just so that your SALT deduction isn't phased down. Okay, so I'll kick it back to Drew for the senior deduction.
All right, thanks, Ryan. So yeah, as you can see, there's a lot of a lot of things to be cognizant of there as we bump up against that limit there for SALT deductions. But one of the major additions through this bill is the extra senior deduction. So for those who are over 65 years old from 2025, so it does start this year through 2028, you get an extra $6,000 deduction per person. And if you're married filing jointly with both spouses over 65, that is 12,000. But they do phase that out at a rate of 6% once modified adjusted gross income exceeds $75,000 for single filers and $150,000 for joint filers, and then $100,000 phase out range. So fully phased out at $175,000 and $250,000 for joint. So for example, if you are married filing jointly and you have $200,000 of MAGI, so that's $50,000 over the limit, times 6%, that's $3,000. And that is coming off of each person's 6,000. So that's going to be 3,000 coming off of both spouses for a total of 6,000. So your 12,000 comes down to 6,000. Now, something that's pretty nice about this extra deduction, it is available for itemizers and non-itemizers. So you do not have to be taking the standard deduction in order to get this extra deduction. So that's pretty nice. And then, one point of clarification is that Social Security in and of itself is still taxable. Because one of the campaign promises from President Trump was no tax on Social Security. And then once the bill was passed, the Social Security Administration sent out a notice that said effectively 90% of Social Security income receivers will owe no tax on their Social Security. And that was certainly misleading in that, it might kind of equate to what would have been tax on Social Security income being eliminated, but it is not directly the fact that Social Security income is not taxable. And also the 90% was a bit misleading because a large percentage already have income low enough to where they weren't paying tax on Social Security anyhow. So just a point of clarification there, in and of itself, Social Security is still taxable. But if we look at the little chart on the right there, I mean, if you're 65 years old, you do get $2,000 in an extra deduction as it is. And if you're married filing jointly with both spouses at 65 or blind, that's $3,200. So, if we look at the new permanent and higher standard deduction of $31,000, if you're both over 65 and filing jointly, it's an extra $3,200. And then if you have MAGI under 150,000, you get the full 12,000, 6,000 each in the extra senior deduction for total deductions of 46,700. So that's just really quite a big number there and going to effectively save a lot of tax for seniors. So that really becomes important, with a lot of our clients, we're doing things like Roth conversions and or even just taking IRA distributions. So we need to be cognizant of, where we're generating income and to what degree we're generating income, because we don't want to phase out of the extra senior deduction for the time period that it's in place if we can avoid it. So a pretty nice benefit here that can really, save a lot of taxes for folks over 65. And with that, I'll kick it back to Ryan to talk about some more extensions and modifications.
And I'm just going to swing right here so the window isn't right behind me in the back. So just continuing on with some of the extensions and modifications. I'm gonna try to just go through this really quick so we can get to some more things at the end here. So child tax credit, it was set to decrease $1,000 in 2026. That's extended and increased from 2,000 to 2,200 beginning this year. The refundable portion remains at 1,700, and the phase outs remain the same as well. The gift and estate tax exemption is also permanently extended, but as Drew as Drew mentioned, tax law is written in pencil. It can be changed. So even though it's extended right now, it doesn't mean it's not extended in perpetuity. So that one um, extended and increased from about 14 million to 15 million. And if you're married, 30 million beginning next year. And it inflates with inflation adjustments after 2026. Deduction for mortgage interest, the amount of indebtedness that you can have, or the amount of indebtedness that interest it is deductible remains at $750,000. But they added back the deductibility of mortgage insurance premiums if you owe more than 80% of your loan. P's limitation, so prior to TCJA, taxpayers with higher AGI limits had a limit on the amount of itemized deductions that they could take. The OBBA permanently repeals that and replaces it with a new sort of cap on itemized deductions for people in the highest tax bracket, 37%. And what it effectively does is reduces the value of those itemized deductions from 37% that they would have gotten to 35 cents for every dollar, which, effectively puts them into the 35% bracket for those itemized deductions. And miscellaneous deductions, the bill permanently terminates those with the exception of educator expenses. And it kind of broadens the definition for educator expenses. So normal ones would be teachers that are buying supplies and whatnot for their classrooms. So it looks like they're going to add a separate itemized deduction for educator expenses, which were usually grouped in with miscellaneous, but they've broken those out. And if you don't itemize and you're a qualified educator, you still get the other below the line deduction of $300.
All right. So to wrap up with some kind of the remaining extensions and modifications we wanted to be sure to discuss is the alternative minimum tax. The Tax Cuts and Jobs Act greatly increased the exemption and the amount of income where the phase out thresholds went up to. So it really only impacts about 0.1% of income earners. However, they did make some modifications to it. They did keep the exemption for alternative minimum tax at 88,000 for single filers and 137,000 for joint filers. They do lower the thresholds by about 20% starting next year. So $500,000 for single filers and $1 million for joint. And then if you reach those phase outs, the rate in which it phases out goes up from 25% to 50%. So it's going to have a moderate increase in folks that are subject to alternative minimum tax. Again, this is for the highest income earners to make sure that some of the things that they're able to deduct are kind of brought back into the equation so that they can, not drive their taxes too low. And so, things for AMT adjustments are large SALT deductions, which again now has gone higher to 40,000 per year. And then incentive stock options if you were to receive those through your company. So again, that's not going to impact many people, but worth mentioning. And then here's a really nice strategy that has been made permanent. So the TCJA introduced what are called qualified opportunity funds. And a qualified opportunity fund is a pool of investors pooling their money to invest in what are called qualified opportunity zones. And these are zones made by, specified by states that are low income, and it gives the ability to do projects in these qualified opportunity zones to, kind of put some investment in some areas that may need it and hopefully help drive growth and kind of refresh those areas. So what a qualified opportunity fund does is it allows you to defer gains on appreciated property, whether it be a stock or real estate, by reinvesting those gains into the fund. So the TCGA had those introduced, and then they ran through 2026. Well, so starting in 2027, they are made permanent. And the way it works, and we have an example on the next page, is that if you take your capital gain and you put it into one of these funds, you have a deferral on the capital gain of up to 5 years. And if you hold it in the qualified opportunity fund for that full 5 years, you do owe the capital gains tax at that point, but you get a 10% step up in basis, which lowers the overall gain amount. And then one thing that they newly introduced in the OBBBA is if 90% of the assets are in a rural qualified opportunity zone, they increase that 10% step up to a 30% step up, further limiting that gain. And then once the money is in the qualified opportunity fund, if you hold it in that fund for a full 10 years, any gain from the qualified opportunity fund investment itself is fully eliminated. So you do not owe any capital gain on that subsequent investment. So if you invested in one of these opportunity funds under the TCJA, it will still be taxable this year. So this is really a strategy that comes back into play in 2027. So if we want to run an example of this, let's say that someone invested $100,000, the investment turned out really well, and it's worth 1.1 million, so they have $1 million of capital gain. And so let's say we've got our $1 million capital gain, we just sell that investment and pay the tax. So we're at a 28.2% total tax rate, which is 20% capital gains, 3.8% net investment income, surtax, and then Colorado 4.4 state tax. So 282,000, that leaves you with 718,000 to reinvest in a new investment. And let's say that you keep that new investment for 10 years and it gets 10% a year. Well, at the end of that 10 years, it's just shy of 1.9 million. And then you decide to sell that again, paying a capital gain on that growth of, a little over 1.1 million. That's an additional 332,000 in tax. So at the end of the day, you're walking away with net of tax 1.5 million plus. But let's say you don't need the liquidity of selling that investment. Let's say you sell a rental property, you just don't want to be a landlord anymore, but you don't need the assets. Or you have a big appreciated stock in your portfolio, and we think, okay, it's time to diversify this. It's become such a large percentage of the portfolio. We want to be sure to diversify it, but I don't actually need that $1 million for a little while. So you take that $1 million gain and you put it in the qualified opportunity fund. So immediately you defer that gain. So $0 are owed immediately at that point. You are able to reinvest $1 million in the qualified opportunity fund rather than 718,000 because you didn't pay any tax. If that qualified opportunity fund is invested for the full 10 years at the same 10% rate of return, it's now worth just shy of 2.6 million. So we're looking at over $700,000 in difference there. And then since you held it for a full 10 years in the qualified opportunity fund, this additional gain of almost 1.6 million, fully tax deferred and tax free. So you walk away with only paying the capital gains on the initial $1 million at the 5-year deferral period, receiving the 10% step up. So $253,800 in tax owed halfway through the qualified opportunity fund investment. So you're walking away with a net 2.3 plus million. So about an $800,000 difference there. And then just to the far right here, if you did the qualified rural opportunity fund where you got a 30% step up in basis That saves you about an extra $60,000 in capital gains at that 5-year mark. So you're walking away with nearly $2.4 million. So in that case, you're over $900,000 in additional growth on that money. So if you don't need to be liquid, this is a really, really attractive approach, and something that is now made permanent come 2027. So definitely something to know that we always have in our back pocket if we have a big capital gain.
All right, so that is the extent of some of the individual provisions that were extended or modified from TCJA to the new bill. So now we're going to jump into some new things that were added in before going into some of the business related provisions, including bonus depreciation. That's going to be in the business section. So kicking this off, some campaign promises: no tax on tips and no tax on overtime. The bill adds in a $25,000 deduction related to tip income from 2025 to 2028, and that's regardless of your filing status. That deduction phases out once your modified adjusted gross income exceeds $150,000 if you're single or head of household, or $300,000 if you file married, filing jointly. So how that one will work is, for example, a single taxpayer with $200,000 of Magi earned $25,000 in tip income. Since their Magi is above the threshold by $50,000, their deduction is reduced by $5,000, which is 10% of that amount above the threshold. So their total deduction is $20,000. Effectively, they have to pay taxes on that $5,000 of tip income, if they report it. And another thing with this is that it doesn't exclude the tip income from payroll taxes. So that's just one thing to note here. And in terms of the different occupations that will qualify, the bill adds language that those occupations had to have customarily and regularly received tip income before December 31st, 2024. So one of the main occupations is kind of like the beauty industry, like barbers and hairdressers and folks like that. The IRS is going to come out with a full list of occupations that qualify for this in the early part, I think October 3rd. So if you're interested in this one, just look out for that. No tax on overtime is very similar to the no tax on tips, except for the deduction. So the tip deduction is $25,000 regardless of filing status. The overtime deduction is reduced in half for single taxpayers. And so that's up to $12,500. And if you're a joint filer, it's up to $25,000. And it only relates to the overtime portion of the time. So if you earn overtime equal to time and a half, for instance, only the half portion of that of those earnings will be eligible for this deduction. And the same phase out rules apply. So it's reduced. The deduction is reduced by 10% of the same income thresholds. And so we have a little comparison chart here on the right. Oh yeah, and it's available if it's not an itemized deduction. It's not completely clear if these are going to be above the line or below the line. In reading the bill, there's clear language that they've added in that says it's above the line, although where it kind of comes out to is actually below the line. And what I mean by that is above the line deductions reduce AGI. And that's important because AGI is used to as a qualifier of certain deductions and credits. As you can see, all most of what we've been talking about, these deductions phase down or phase out depending on your AGI. So that's kind of important for folks that will qualify for this, if this is going to actually reduce their AGI or not, and where this is going to end up on the tax return. It's just not totally clear yet. I've seen it both ways, where people are saying these are above the line deductions or these are below the line deductions. So I think we just have to wait for the IRS to come out with clear guidance on that. So yeah, that's about it for no tax on tips and overtime. Take it back to Drew.
All right. So some of the other new individual provisions is auto loan interest deductions. So you're able to now deduct 10,000 of qualified interest for the next 4 years, including this year. So similar to a lot of the other new provisions, you do not have to itemize to have this available to you. So you can take the standard deduction and still be able to deduct up to 10,000 worth of auto loan interest. It does have a phase out as well. So the phase out begins at 100,000 for single filers of Magi and 200,000 for joint. The loan must have originated in 2025. So if you bought a new car in 2024, unfortunately, that does not qualify. It has to be a new car this year and through 2028. Used vehicles and business commercial use vehicles do not qualify. And it has to be less than 14,000 pounds. But the key here is that it has to have final assembly in the United States. So it's kind of incentive to buy American-made cars, even though not all of it is necessarily having to be fully made and assembled in the U.S. It just has to have final assembly in the U.S. So if you're looking for a new car, consider buying one that was assembled here in the U.S. and you might be able to itemize the interest, or not itemize, deduct the interest on a loan if you do finance it. Now, there were some changes to 529 plans as well. So a handful of years ago, they allowed 529 plans to allow for K through 12 tuition. So if you sent your kid to a school that you had to pay tuition at, you were allowed to take up to $10,000 from a 529 as a qualified distribution to help pay for those. They have expanded that to be more in line with what it's like for college. So now you can use it for books and materials, tutoring, standardized test fees, and educational therapy costs, things like that. And the new qualifying expenses are in fact effectively immediately after the bill passing on July 5th. So anything from the second semester of last school year does not qualify, but everything for the first semester of this year does qualify. And starting in 2026, they double that $10,000 distribution limit to $20,000. However, while this is nice, it is important to understand the state rules for your 529s. When they allowed for it to be used for K through 12 expenses, they left it up to the state in which the 529 plan was run through as to whether or not they would, honor the state tax deduction. Colorado, for example, does not honor the state tax deduction, only if you use it for post-high school. So if you do take out the 10 or next year 20,000 to pay for, say, private school, Colorado will recapture the state tax deduction that you received for that initial contribution. And another nice perk here is for post-secondary credentials, you're now allowed to utilize your 529 as well. So for example, Ryan here passed his CFP exam last year. He is unfortunately a little too early on that, so he could have funneled his expenses through a 529, got a state tax deduction, and then pulled that money out to pay for those expenses. But moving forward, folks can do that. So, things like a CPA or things like that, you're allowed to utilize 529s for. Then a couple of quick ones to wrap up this slide. Limitation on wagering losses. So you used to be able to deduct 100% of losses against winnings. So as you can see there, for example, if you had 100,000 gambling winnings, but you also had 100,000 in gambling losses, that used to fully offset. Now they're only allowing 90%. So you'd only get a $90,000 deduction. So even though you broke even, you still owe tax on $10,000 worth of those gambling winnings. Um, so, generally that's not much of an issue because most people just lose much more than they win if they win at all. But if you do gamble in any serious dollar amounts, that could come into play. And then last, overseas remittances. So for income earned in America that people send to their family back at the country that they came from, that is now taxed at 1%. So whereas it was not taxed at all prior. So not a big number there, but that is taxed moving forward.
Yeah, I will definitely probably be using that 529 for continuing education. Um, I'm pretty sure that that falls under the new qualifying expenses. So that's also good to know. So charitable deductions. There have been some changes to this one. I'm going to jump straight into the examples for the sake of time. So, well, to give a brief overview, there has been the bill adds a 0.5% floor on the amount of deductible charitable contributions that you can make as an itemized deduction. Um, and it also permanently restores the below the line deduction for non-itemizers. So if you take the standard deduction, you can still give $1,000 if you're single or $2,000 if you're married filing jointly in cash to a qualifying charity and get a deduction for that. So for the planning considerations on this one, we're going to go from the perspective of a married taxpayer, AGI of $200,000, who usually gives $20,000 to their church, which is a public charity. Now that the state and local income tax deduction is increased, they can now itemize. In their current giving, the AGI limit for cash contributions to a public charity is limited to 60% of your AGI. So for this person, that's $120,000. With the new 0.5% floor on charitable deductions, that comes out to $1,000, which is unallowed as an itemized deduction. So it reduces the $20,000, reduces the deductible portion of the $20,000 that they gave. So they come out with $19,000 that they can get as an itemized deduction. And because the total amount that they gave doesn't exceed the AGI limit, that $120,000 figure, they can't carry forward the amount that was disallowed under the 0.5% AGI floor. So that's just gone. I mean, they still gave it to charity, so it counts, for being a good person in charity, but they just don't get a benefit for it and it's lost. So what we can do to make sure that that $1,000 isn't lost, one option is to front load a donor advised fund. If you're not familiar with a donor advised fund, it's basically a your own personal foundation, and when you give money to it, you get a charitable deduction that you can use in the year that you contribute to the DAF. So if this taxpayer front loads 4 years of giving to this DAF with appreciated securities, that comes out to $80,000. You apply the new floor, that's $1,000. It's still based on their AGI. So total of $79,000 is allowable for a deduction. Then you apply the AGI limit. which for appreciated securities using the fair market value, that's limited to 30% of your AGI, which is 60,000. So that's where the total amount given to the charity exceeds the AGI. So now the deductible portion is $60,000. Their carry forward due to the AGI limit, just 79 minus 60 is $19,000. And then they can also carry forward that $1,000 that was disallowed by the floor since their total contribution exceeded the AGI limit. So that's one planning opportunity there. Another one that we use often in plans is to satisfy your giving with with qualified charitable distributions. This is available if you are 70 and a half and you have an IRA. You can give directly to a charity of your choice, directly from your IRA. So you don't have to take the money out of your IRA, trigger a taxable event, and then give it to charity. So it's a much more tax efficient way to give. It also satisfies it counts towards your annual RMD, reduces your taxable income, and um, could leave more room for Roth conversion since your taxable income isn't so high. So that's got 10 more minutes left. So um, this is just a good chart. It kind of looks like a scatter plot to me, and it kind of reiterates the opportunities that we have for income tax planning. Since the estate and the gift and estate exemption is so high, um, planning estate planning isn't that much of a concern. But with all these new provisions and the different AGI thresholds, it gives a lot of room or gives a lot of opportunity to do some good income tax planning. I'll kick it back to Drew.
All right. So one of the new provisions in this bill was the introduction of what they're calling Trump accounts. And a Trump account is effectively a way to save for retirement for a child or grandchild, or really any child. You could do it for your neighbor if you wanted. Um, but beginning in July of next year, you are allowed to make $5,000 non-deductible contributions for children under 18. There are some rules. It's kind of easiest if we look at that chart there on the right for the rules from birth up till 18 versus distribution rules thereafter. But you're not allowed to take any distributions while the child is under 18, other than to roll this account over to a 529 ABLE account, which is designated for children with disabilities. Now, it is allowed, of course, to be invested, but it is rather limited. So, you can do like an S&P 500 fund or a Russell 2000 fund if you want to be invested in small caps. But, you can't do individual stocks and things like that. So it has to be invested in an index composed of primarily US equities. And if the child is born this year through 2028, the government will put $1,000 into it. And that they do that automatically. So you don't need to open it and coordinate with them. They'll just do it automatically. And then starting next year in July, you can start making $5,000 non-deductible contributions. And why this is nice is because a lot of folks, for example, no one knows if Social Security is going to be there in 60, 70 years when these children are retiring. So you say, hey, let's give them a jump start on retirement savings and let compounding do its magic. Historically, you'd say, well, I don't want to open up an IRA or a Roth IRA, but I can't because to contribute to an IRA or Roth IRA, you are required to earn income. There are no income requirements here. So you can just simply contribute to this on their behalf without them needing to work. And then let's say they're 15 and they get a summer job and they want to save into a Roth IRA, your $5,000 that you put into one of these Trump accounts does not count towards their contribution limit. They can still put in their full $7,000 into the Roth IRA, and you can do this additional 5,000. Now, once the beneficiary reaches age 18, it basically just begins to follow regular IRA rules. So distributions are allowed at that point, but like a regular IRA, if you take out a withdrawal prior to age 59 and a half, you do pay a early withdrawal penalty and income tax on the growth. Because the contributions are made with after-tax money, that does kind of create a cost basis. It's only the growth that becomes taxable when distributed, but tax on the growth and a 10% penalty would be applied at that point. Now, some nice features here is, for example, the government's going to contribute $1,000 for kids born over the next few years. There's nothing that's disqualifying state or local governments from doing the same at some point. And that does not count towards your $5,000 limit. So if you want to start saving for a child or grandchild, you can do so. And that $1,000, for example, that the government puts in does not lower your limit there. And we might see this become kind of an employee benefit where employers contribute to these. They're allowed to do up to $2,500 a year. And that also that is a little different. That does seem to count towards the $5,000 limit there. So, but basically the rules here is once the child turns 18, it more or less just becomes a regular IRA. So RMDs will still apply and all of that. So a nice little benefit if you want to get a jump start on saving for retirement for a child or a grandchild. And so there are several business-related provisions with this bill. And I think to me anyways, and what's most applicable to our clients is the qualified business income deduction. So there are 25 million pass-through small businesses in America. So pass-through means you're like an LLC or a sole proprietor or an S corporation, and the income passes through to your individual return. And the Tax Cuts and Jobs Act introduced this 20% deduction for qualified business income. In this new bill, it is made permanent, which is nice because this was going to go away starting next year. So a lot of small businesses will continue to benefit from this. The only thing they did is made small modifications in that they are expanding the phase out range. It used to be $50,000 range for single filers, $100,000 for married filing jointly. They're increasing that to $75,000 and $150,000 respectively. And they made no changes if you're a specified service trader business. So financial advisors, accountants, lawyers. Once phased out, you are completely phased out. There's no getting it back. If you are not an SSTB, the rules remain the same. You are allowed to bring in W-2 wages and depreciable property to bring back some of that qualified business deduction. Also, they made permanent the qualified small business stock gain exclusion. So this is for C corporations, so small businesses that are C corporations. So that's different than the above, which were pass-through businesses. A C corporation is not a pass-through. The corporation pays tax itself. And then dividends paid to the business owner are taxed at the individual, so they're dual taxed. But for C corporations with 50 million or less in assets, if you acquire this qualified small business stock after the bill was passed, so after July 4th of this year, you are allowed to exclude from any capital gains what is now 15 million, whereas it was 10 million prior. So if you hold the stock for at least 5 years, you get that full 100% exclusion up to 15 million. If it's held for 4 years, it's 75% exclusion, 3 years, 50% exclusion. And then they also made permanent the excessive business loss. So if you're a small business owner and say your spouse works for a company and just earns W-2 wages, they limit how much, if you run a loss through the business, they limit how much of that other ordinary income can be offset. Beginning next year, they do bring the limit down actually a little bit. It's going to 500,000 joint and 250,000 for all others. And if there's any losses exceeding that, it does carry forward under the net operating loss rules against up to 80% of taxable income there. So those are some of the business related expenses, provisions, I keep saying expenses, for small businesses that are pretty nice if they're applicable to you.
Uh,
And then, sorry, finally, we have gains for farmland sales. So if you have a gain from selling farmland through qualified farmland to a qualified farmer, you are able to spread that out over 4 years versus having to take it all in 1 year.
okay, here is the fun stuff. So bonus depreciation. First of all, if you're a rental property investor or a business owner, you're probably familiar with depreciation in general. But just as a high level, explanation, depreciation is an expense you're allowed to take based off of the cost of an asset that you acquire, and it's usually spread over the useful life of that asset. So typical useful life, 3, 5, 15 years, 20 years. And for buildings, non-residential buildings are depreciated over 39 years. Residential rental buildings are depreciated over 27 and a half years. That's going to be important when we go down to the qualified production property expensing. So bonus depreciation was 40% this year under the Tax Cuts and Jobs Act. The bill reinstates it to 100%. So if you acquire an asset with a useful life of 20 years or less, which are, machinery, equipment, qualified improvement property made to the interior portion of a rental property, for instance, you can elect to bonus those assets and take a 100% expense in the year you acquire it, and this is made permanent as well, so it goes beyond the current year. The one gotcha for this is that the 100% applies to assets acquired and placed in service after January 19th, 2025, which is Inauguration Day. So if you bought a piece of asset before that date and then later place it in service this year, you're stuck with that 40%. So bonus depreciation reinstated permanently at 100%. That's huge for people that want to invest in their business, real estate investors for sure. You can generate some serious losses by doing a cost segregation study, which I have an example on the next slide of. Leading into another provision, Section 179 expensing is kind of similar to bonus depreciation. Not so sexy as they say, since now bonus depreciation is 100%. But there are some caveats with this one. So it's the same sort of mechanism where you can elect to expense a certain dollar amount of the assets that you acquire in the year that you acquire and place it into service. So though the deduction has increased from 1.25 million to 2.5 million, and the property threshold, the amount that a business that can purchase increased from about 3 million to 4 million. So it covers the same type of assets. 1245 property is personal property. Machinery and equipment. Livestock is also included in that. appliances that are found in a rental property. One of the differences is that there's certain kind of QIP or qualified improvement property that qualifies for Section 179 include roofs, HVAC systems, and security systems, which aren't eligible for bonus. So that's an opportunity for a real estate investor, for instance, who wants to replace their roof and can't bonus the whole thing if they want to take a full expense, and they can use Section 179. Um, and this one, and the other important difference is that bonus depreciation is applied on an asset class basis. So if you buy a bunch of property, like $1 million worth of 10-year property, and you want to use bonus for your 10-year property, you have to apply it to the full asset class, all of that $1 million. Section 179, you can cherry pick it a little bit more and apply it on a dollar amount figure. So that's another planning opportunity. Um, Qualified production property expensing. This was super interesting to see in there. So bonus depreciation, 100%, 100% expense that you can take for assets with useful life of 20 years or less, which obviously doesn't include the structure itself of property, for instance, which is depreciated over 27 and a half or 39 years. Qualified improvement property lets a business expense the structure of the production part of the building. So usually this would be depreciated over 39 years. Now, if you qualify, you can expense the full thing. So couple that with bonus depreciation, and those are some serious losses that a manufacturer or a producer can generate in 1 year. Um, so the IRS is also going to come out with more guidance on this, obviously, and kind of really define who is eligible for this. What's clear now is that like bars and restaurants are not. So if you buy a restaurant, it's a trader business, it's depreciated. The structure itself is depreciated over 39 years because you're basically producing food and beverages. You can't take a full expense for that. Um, yeah, so let's go to a example of bonus depreciation. Um, so here we have a rental property investor um, buys a rental property for $500,000. Of that $500,000, 100K is attributable to the land, which is not depreciable. So that's why it's split out. The rental property does qualify as a trade or business. Um, I'm not going to go into that, but a some rental properties don't qualify as a trade or business, but um, some do. It's pretty complicated, but this one we're going to say this one does. And after a after the investor does a cost segregation study, which which is it's determined that 30% of the $400,000, which is 500 minus the 100, is attributable to assets with a useful life of less than 20 years. So what a cost segregation study is this person bought a property, not including the land. The whole thing's worth $400,000. Cost segregation study splits out the different kinds of assets that are inside of that property. So from the structure itself, the building itself, that's going to be depreciated over 39 years because this is a trade or business. Um, they split out the other kinds of assets like the cabinetry, the appliances, any kind of removable flooring or decorative kind of objects, things like that. So this is how you can accelerate the cost of your investment and generate some serious losses. Um, so they split out they split out those assets. 30% of it is attributable to 20 years or less of the useful life, which is bonus eligible. So they can essentially take a $120,000 loss against that rental income. But there are some caveats when it comes to rental property investing. Generally, rental properties are considered passive activities, which means that regardless if you materially participate, unless you're a real estate professional. There's a couple different ways that you can flip the switch from passive to a non-passive activity. And the reason you would want to do that is because you would be able to take that $120,000 in this example, bonus depreciation, and apply it to your other active income, such as W-2 income or a Roth conversion, for example. So first scenario here, we're going to say it's a passive activity, and they actively participate, so they make management decisions. The deduction that they can take is limited to $25,000, which is also subject to AGI limits, and that's due to the passive activity loss limitations. So in this instance, the person may not want to take the full $120,000 of bonus depreciation and instead elect to bonus certain longer lived assets and depreciate the shorter lived assets over the normal maker's depreciation schedule. So this will give them the immediate benefit up front, and then allow them to better match their depreciation expense with the income that they're going to be generating from the rental property. So if we are able to flip that switch from passive to active, there's a lot of hurdles you have to go through. The biggest one is materially participating in the activity. So a real estate professional, it's 750 hours, and it has to be more than any other activity that you're involved in. Short-term rental loophole. It has its own material. There's different kinds of participation levels that you can qualify for, but another added hurdle is that the average stay has to be less than 7 days. And so if you qualify for one of these, the losses that you generate from the rental property can be used to offset, your active income, W-2, Roth conversion, pension income, etc. So in this instance, the person may want to take the full bonus depreciation amount to $120,000, use and offset their active income if, say, they're married, one person's retired, the other person's not. The one person's earning W-2 income, the other person is managing the rentals and qualifying for one of these classifications, and that's how you can offset the other person's W-2 income. Or just use the proceeds from a tax refund to reinvest into another property, and kind of start the cycle over again. So that's an example of bonus depreciation. And we'll kick it back to Drew to go through the last bits.
All right, thanks for that, Ryan. I wonder if anyone can tell if he's a CPA or not. So to wrap up, we'll just very quickly go through our energy credit repeal. So this does repeal pretty much all the energy credits that taxpayers were able to get. So the top one there, the electric vehicle charging equipment installed at your personal residence, which was a credit of $1,000. That's over and done with. That needed to be placed in service halfway through this year, so that's over. The clean vehicle, which was $7,500 for new vehicles or a $4,000 credit for used, that terminates at the end of the third quarter, so September 30th. So if you're looking to get that electric vehicle and get a credit for it, do so in the next month and a half. The energy efficient home improvements, a $1,200 credit, that must be placed in service before the end of the year. That's windows, doors, insulation, things like that. And finally, the residential clean energy credit, which is solar panels, wind power, geothermal heat pumps, things like that. Up to 30% of the cost or installation was allowed to be used as a credit. That also needs to be done by the end of the year. So if you're looking to get a car, do so very quickly. If you need to want to do these improvements to your home, do so before the end of the year if you're looking to get any kind of tax credit for those. And with that, that wraps up for today. And I know we're a little past time, so thank you so much for tuning in. Just coming soon here, we do have a monthly newsletter that we're going to introduce starting here in September. So we'll have some timely market information and financial planning information coming out in those. So we'll be sending that out each month starting in September. So keep an eye out for those. And with that, we will see if we have any questions. As of right now, I'm not seeing any, so feel free to plug those in if you have any questions before we wrap up here. And we do have to run through the disclosures on where we sourced all of this information. But yeah, feel free to throw in a question if you have any today. Otherwise, of course, we are always available for you to reach out to with any questions you may have. And I think really the takeaway from the One Big Beautiful Bill Act is that it gives us a lot of certainty in making a lot of the Tax Cuts and Jobs Act provisions permanent. And then it gives us some new strategies to work with. And then there's a lot of different moving income thresholds and things like that. So it's really important to update your plan and to be doing annual income tax planning if we're going to be implementing any types of strategies. So as always, we thank you so much for your time and we appreciate it very much. I don't see any questions. So with that, we will go ahead and let you get back with your day, back to your days. Thank you so much, and we'll talk to you all soon. Take care.